Hello, hello, John S. Rhodes here. And how should you diversify your portfolio? That is the question of the day. We've had a lot of questions that have come in, and this is one of the most important. It's all about diversification of your investments. So, there are a lot of questions about diversification, which means rather than focusing or concentrating your investments in, let's say, one or two securities, or just in real estate, or just in gold, just a few examples there. How do you diversify into many different asset classes? Now, I mentioned a few. You've got commodities, you've got real estate, you've got stocks, you've got bonds. A lot of times diversification really is about spreading risk across different assets. And typically you want to have these assets be uncorrelated. So if you're investing only in real estate and you think, oh, I'm going to invest in office space, I'm going to then invest in strip malls, I'm going to then invest in, let's say, multi unit residential, and so on. Well, you're still in real estate, so your diversification in that sense is quite limited. So let's talk about the three most important points about diversification. So I took a couple notes here. I want to make sure that I get these things across loud and clear as fast as possible. For the first thing here is you do want to spread your investment dollars across different asset classes. So I've mentioned this, and it does come down to these uncorrelated assets, these pools of money that move in different directions, totally independent of each other. Now, you can't get that because when the economy tanks or when the stock market tanks, then what typically happens is that all asset classes, or nearly all asset classes, start to drop. Okay, so things do move together, but you do want to diversify in such a sense that they are as uncorrelated as possible. Now, why is that? Well, that's because if, let's say, gold is skyrocketing, a lot of times things like bonds might be falling, or maybe even stocks might be falling, but the bonds save your bacon. The bonds are what, stabilize things. Gold might be the winner right now, but the stocks might save you later on. So some things go up, some things go down, and overall, because you've diversified, you kind of smooth things out. Now, the more risk that you want to take, the more you would concentrate your money, your dollars, your investment dollars on what you think is going to work best. So some people do that. They have a very concentrated portfolio. They watch these particular asset classes very closely, and they maybe trade in and out. Maybe they have even long-term bets, not just months, but years, even decades. So it kind of depends on what your risk tolerance is, what you're looking for. Are you looking for more of a balance over time so that the fluctuations aren't crazy and maybe they're more like this? So steady state, more stable, you're going to get more of that, more stability in general, not always, in general, the more diversification that you have. So again, spreading your risk, spreading your money across different asset classes. Let me touch on some of these again in case you missed it because I went through it fast earlier. Stocks, bonds, real estate, and even cash as a ballast, something that kind of keeps things steady over time. And again, that's to sort of balance out the risk and reward that is available in these asset classes. And in aggregate, when you put them together, it sort of smooths out your portfolio. So that's the first bullet point. The second one is you want diversification within each asset class as well. If we pick something like commodities, you might pick, I don't know, oil or timber or gold or silver, or I should say, and pick all of those. A little bit of this, a little bit of that, a little bit of this, a little bit of that, and that's going to help you quite a bit. And that would just be, for example, within commodities. So There are other ways of thinking about this type of diversification. For example, investing in a variety of industries, sectors, geographic regions as well, and that will reduce the impact of poor performance in any one area. And so you can kind of think about this as a matrix, right? On the one hand, you have, stocks, bonds, commodities of various sorts, right? So you have things broken up in that way. But what I'll tell you is that once you go into any particular asset class, you might want to diversify from there. So let's take oil and gas, for example. You've got the companies that are not integrated and they just do something like exploration. So they're looking for new wells, new opportunities, new deposits, basically new opportunities. They're out there and they're wildcatting almost, drilling all over the place, buying land, doing the research. And then at the other end of the spectrum, you've got the companies that they're selling, let's say, gasoline at a station, at a petrol station, at a gasoline station. In that case, you're talking about the other end. It's already been refined. It's something that's going to go into a vehicle, and so on and so forth. But this is the exploration and this is the end use, right? So that would be a type of diversification. And then you've got midstream partners as well. And what they do is they actually transport the oil and gas through these vast pipelines and tankers and through other channels as well. All right. So again, you want to have diversification between, and then you want to have diversification within. So you have plenty of diversification. And a lot of times something like a target date fund is definitely going to do bits and pieces of this for you. In other cases, you will be able to get diversification through the kinds of companies that you pick. Let's say it's like an ExxonMobil or a Chevron. They are a vertically integrated, oil and gas, transport, refining type of business. They're fully integrated. And they sell worldwide as well. Something to keep in mind. Definitely something to keep in mind there. Okay, and one more thing here, right? So we talked about number one, spreading across asset classes. Number two, diversifying within, so between and within. And definitely, last but not least, in terms of diversification, we've got rebalancing on a regular basis. So periodically adjust your portfolio to maintain your desired level of diversification and risk tolerance as markets fluctuate. So what does this mean? What it means is that a lot of times people, they set up a portfolio with a variety of different types of assets, as I've gone through so far. And then what they do is on a periodic basis, like once a month, once a quarter, twice a year, once a year, they pick something like that is in line with how often they want to check their portfolios, and then they adjust and bring things back into alignment with the original portfolio setup. So let's just go through an example here. You might put 5% in gold, 5% in cash, 10% in Bitcoin, 40% in stocks, 25% in real estate, and then 10% speculation. That could be like, little startups, or it might be some little local business of sorts, things of that nature. If you add all that up, that's 100%. And what might happen is your Bitcoin might go crazy and wild. I've talked a lot about Bitcoin on the Rhodes Brothers channel. You can read all about it. You can also watch the videos here on the Rhodes Brothers channel. Okay, very, very importantly, so let's say Bitcoin goes absolutely parabolic, crazy, nuts. It just goes whoosh, and rises like crazy. Well, let's say you rebalance twice a year. You might want to sell down some of that Bitcoin that went wild and crazy, right? Whoa! Bitcoin goes wild and crazy. Well, then you sell some of it off, and then you put that money into the other areas that maybe haven't done as well. Maybe gold hasn't done as well. Maybe real estate hasn't done as well. Maybe stocks haven't done as well. So you'd trim down back down to the target allocation of 10%. That's your target allocation of 10% in Bitcoin. And let's say now it's 20%. Well, you trim about half of it, right? And that brings you back down to 10%. And let's say stocks are down. Well, you can take that extra cash that you just trimmed from the Bitcoin and then put it into stocks, for example. Okay, lots of examples because obviously the markets are changing all of the time. So that tells you exactly how to think about diversification, what diversification means. One of the new concepts for most people is the diversification between asset classes, but also diversification within asset classes. And then once you know what your set diversification plan is, once you know what your portfolio allocation is, fantastic, because that means that you can then rebalance on a periodic basis, quarterly basis, twice a year, once a year. And that's how you can very easily diversify your investment portfolio. Again, my name is John S. Rhodes of the Rhodes Brothers. This is Greater Wealth Through Mastery. Please like this video, and more importantly, please subscribe. A smaller than I would like percentage of people are subscribing, so they're missing out. Perhaps you are missing out on an opportunity for the new videos to be in front of you at the right place at the right time here. So by all means, please subscribe, leave a comment below as well. This is Greater Wealth Through Mastery. John S. Rhodes signing off. We'll see you in the next video. Thank you very much.